The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy.
On this episode of Pennies Going in Raw, we give 3 trading strategies on swing trading, day trading, and options on large stocks.
Yeah, boy.
Pennies Going in Raw.
Featuring Dan, Deity at Dukes, and Hugh, honey.
New intro under construction.
This episode is sponsored by Masterworks.io. Ever wonder how billionaires like Bill Gates and Jeff Bezos hedge their risk? They invest in blue chip art. Contemporary art prices outgained S&P 500 returns by 174% from 1995 through 2020. Masterworks.io is the only platform that lets you invest in paintings by artists like Banksy and Monet at a fraction of the entry cost. It's no wonder 84% of wealth managers recommend investing in art. Masterworks.io is making art investing accessible to everyone. They recently sold their first painting, a Banksy work, for a 32% annualized return to investors. Pennies Going in Raw listeners can skip their waitlist today by going to Masterworks.io, promo code PENNIES. See important information at Masterworks.io/disclaimer.
Welcome back to another episode of Pennies Going in Raw. Today is Sunday, July the 11th, and we've got some strategies for you. We got some things to talk about. And I guess we'll start it off. I'm mainly a day trader. I've been dabbling in options, mainly day trading options. And Hugh, big swing trader. Recently had to start day trading a little more. Marco's down. He's got to get it how he lives, So yeah. I guess where do you want to start? You probably want to start with swing trading, huh?
Let me start with...
Or I guess before we start with any of these that we have listed, maybe something, short and easy, like large caps in general. If you just want to swing a large cap, so something short and easy, what kind of advice do you have for that? The apples, the buy them and hold, or do you wait for a good spot to buy, or what's up?
Yeah, so something that I did want to talk about was the notion that you need money to make money. Because that is true to a large degree, okay? Making 10% on $1 million account is double the average American salary. Making 10% on $10,000 and you're barely getting a hotel room in Florida for the night. So
it's an expensive hotel room.
Well, no, I don't know. I haven't traveled.
Okay, 10%, $1,000. Yeah, I mean that is.
Yeah, but you get my point. Okay. We could say you can't even get a Porsche. Wink, wink. So my point is that there is a degree of notion, but that being said, it's not like everyone's given $1 million. Every trader is given $1 million at the door and told to to figure it out.
Imagine.
Yeah, exactly. In fact, it's a good thing that's not a thing.
Dude, they should make like another market for paper traders that doesn't have anything to do with the real market. It starts off as the real market, but like you just get $1 million and you see how it reacts to everyone just having infinite money.
It would be horrible. It would be so bad. I can't even imagine.
Like $1,400.
I was just going to say, slap some 2 mil float stock and send it halting or something, and then they can't get out of it because it's too liquid. Something along those lines. Now, back to what we were talking about was that the notion that you need money to make money, that is true. But if you build up an account, you're not the first person to build up a fucking account. Okay. In fact, you probably wouldn't even be the first 10 millionth. Okay. Everybody builds up an account to a certain degree, even if you are given seed money. Or let's even take a hedge fund. Okay. If you're lucky enough to work at a hedge fund, they start you as an apprentice. You just learn for a year or two. Then they give you a small book, and then they give you a little bit larger book, but you're building that book. Like, you still have to hit crazy numbers. So to a certain degree, you still have to build up an account. Now, Obviously, they're not building up an account from $500 like most retail. So if you are inside that position, understand that yes, you do need to build up an account, and it is difficult to build up, but you won't be the first, and you sure as hell won't be the last. So don't reinvent the wheel. And what I mean by that is keep it nice, systematic trading. Learn your system first, figure out what you're good at, figure out what you're not good at, and figure out a strategy that can be replicated multiple times and it has a winning edge. Okay? Now, once you do that, then you can slowly build up the account. And again, don't reinvent the wheel. Quality over quantity. Okay? You don't try and, although I use the expression, I'd rather get off the bus stop 5 stops too late than 1 stop too early. That's true. But don't turn it into a situation where a stock goes up 100%. You ride it all the way up and all the way down and sell it for 2% gain. Okay? That's not going to fly, and you're never going to make it. Okay? So it needs to be quality. Go ahead.
Percent stop loss. Trailing stop loss. Boom.
Boom. Exactly. And even if it comes down to your trailing stop loss and that's the lowest it goes and it shoots up, guess what? You followed your plan. Okay. You're never going. I mean, there's probably been 3 times inside my career where my plan and the trade has gone exactly perfect. I should frame those because it never does. It never does. But that's okay because that's the market. You know, like when I first started out, I think I tweeted this 2 weeks ago. I had said that when I was starting out, I had a goal to go a decade without a red trade. Okay, because at that time, I thought that it was completely on me. I thought that my performance was purely based on how hard I worked. I didn't understand that there were outliers of the market. So you have to understand that it's not everything's inside your control. Okay. When you work at a desk job, besides being sick, besides catastrophic errors, catastrophic losses, there are, to a certain degree, you can control mostly everything. With the market, that's not how it works. At any moment, there can be a catastrophic loss. So I wanted to put that out there. Okay, if you are building an account, don't reinvent the wheel. Don't feel bad for yourself. Okay, for 5 years, I didn't make dick. And, now 1% gain is
now you're getting a lot of dick.
Motherfucker. Now, and that's the thing is that you will build up an account. And it will be hard. But once you build up that account and 10% is the average American salary, you can say you've made it. Because then at that point, you can completely switch to a completely not risk-free, but where your risk is super low, where you really manage your risk overall so that you never really lose more than 1 or 2% of your portfolio inside a position. And if you do that, then you can make 20% a year. And then the next year, instead of it being the average American salary, it's like, and then it's above the average American salary. And then then once you start to compound, you start to roll, it just gets stupid. And then one thing that I do want to share with you is Warren Buffett said something, and I love the big man. He said,
Do you guys understand why making a podcast with you is so difficult? I literally asked him how you would recommend adding a large cap stock, and he just went on a 6-minute rant about do you need money to make money? Now he's getting Warren Buffett quotes on his phone. So what I do for large caps mainly is I actually do it in my Cash App account of all things, because you can add partial shares, and I'm one of those guys for large caps. I don't like to look at them at all. I'm not even great at swinging things unless I put them in an account that won't let me look at it except for once a week. So I do them in Cash App, and I just try and throw like $50 in one every day, you know, whichever one looks like it's on a dip, you know, whether and Cash App has a ton of them. And the only reason I keep saying Cash App, this is not an ad. I'm not sponsored by Cash App. Kevin O'Leary, if you want to, though, I am here.
Yeah.
Yeah. Yeah, I mean, it's super easy. It's actually where I bought my first stock, and I just try and throw it in every now and then, and I just don't ever look at it. If it's down, it's down. It's up, it's up, and you know, it's always going to have a good bit of money in it should anything go wrong. How do you kind of go about adding them?
Yeah. So for the most part, I don't usually own any large caps.
Not even in your Roth.
No. I do own inside the Roth, but I'm saying inside the trading account, I usually don't own anything. Inside the Roth, I have, we talked about last week, but Amazon, Visa, MasterCard. I like the emerging markets and places where I see like innovation. But for trading purposes, I usually don't hold the equity because I would need a massive move. I mean, it's the same provided that you would need a massive move to make any kind of money. Now Amazon was up 0.5% today. So, I mean, I guess if you were all in, that's not a bad day. But the strategy that I like to take with the large caps is I like to do an option strategy. Now, this strategy isn't going to be for like the newest trader out there because you do have to understand technical analysis on a pretty good level. And what I mean by that is that my strategy is simply charting, buying options on support 10% out of the money with low delt and cutting on really green days and adding on really red days. So it seems complex, but when you think about it, I'll take the Amazon trade that I took.
Yeah, so I think kind of explain, like, what do you mean? I know we've explained it before, but low delta, how should they look for low delta in an option trade this out of the money?
Yeah, so I don't like there's people that will comment underneath this podcast like what about the
Fuck 'em.
What about the other Greeks? And yes, and the other Greeks are important, but for me, the most important for me is the delta because I don't necessarily I'm not throwing 50% of my account into this. This is something where I'm looking for an explosive move to the upside. And so if it's either going to work or it doesn't, when I talk about options trades, I use the quote banker bankrupt because I'll hold it down 80%. But like, for instance, the Amazon trade that I took, I was seeing that it was consolidating for an entire year across the chart. So it had touched the level, it had touched resistance twice, and it was really starting to gain volume to the upside. So I said, hey, if this breaks out, I mean, this thing's going to explode. So when it came back down to support, I bought low delta, so 40, 50 deltas. I bought the Julys and I bought the Septembers. And the reason I did that was because I usually like to buy right below where my price target is. So my price target for August, for August was $38.50 for Amazon. Okay. And so I bought the September low delts at 3,700. And so what this did was that this gave me enough time for Amazon to work out its kink. So I was down like 25% or something.
Yeah, and on Amazon calls, that's a lot of money. Like these are penny stock options. They are expensive.
Yeah. Exactly. So they're expensive. So I was down 25%. But like I said, is that I kind of have like a rule of thumb where I just kind of add on really big red days. And so that's what I was doing. And let me see, Tuesday or Monday or Tuesday, it broke out of that resistance, Amazon, that yearly resistance. And it was up like 4.5%. Bezos made like $8 billion that day. So that's when those options go up 500-600%, and the overall position I was holding went up like 200%. So for my account, I don't need to, I'll throw 1% of my account in, so I'm risking 1% to make 2, 3, 4, potentially 7%. So now what I did was that on that big explosion, I cut most of them on Tuesday because it was kind of like that, like first big explosion. And then when it opened up higher than where it closed, that's where I felt like, okay, I'm just going to close the rest. It opened up like 1.5% up. And I said, okay, this is maybe a little too much. So that being said, I sold 80% of my calls. So now I locked in a huge profit. But if this thing wants to keep going, fantastic. I'm up a hell of a lot. My net liquidity is still high, but I locked the profit. But now what I want to see is that if Amazon comes back down to that support, that's where I'll add, like, let's call it October 3900s or 3800s, because that would be a really great. So what we saw was an explosion to the upside. What I want to see is a retest of the support or a back test of the support. And as it starts to curl back up, that's where I'll scale into options. And that's where I can take a bigger position. For people that have been following us for a while, PFE was a 7-figure trade for me, Pfizer. And that's because what I do is I like to get into the option. Okay, it's a farther out option. And I like to understand the stock a little bit. And so the only way for me to truly be all in on, or, be all in and focus on the stock is to have some money in there. So now if Amazon comes back down and starts crawling back up, that's where I'll scale in and I'll try and hit like a pretty good home run trade. But again, it comes down to quality over quantity, getting a strategy that's systematic and works for you. Okay, my strategy is not going to work for everyone, but it's a strategy that you can replicate with little risk and you can maximize your reward.
That's awesome to hear, man. So obviously it's been 15 minutes into the podcast and he still hasn't answered my first question, which makes me kind of, it makes me kind of, how do you just buy large caps in general? But it makes me upset. It makes me want to have to talk to someone. And and that's why this is kind of brought to you by BetterHelp, our sponsor, for me needing help from Hugh, doing all this to me. If something is preventing you from achieving your goals, something's interfering with your happiness, check out BetterHelp.com/PGIR. BetterHelp will assist your needs and match you with your own licensed professional therapist. It'll connect you in a safe and private online environment, and it's super convenient. You can start communicating in under 48 hours, and it's not a crisis line. It's not self-help. It's professional counseling done secure online, where you can message a counselor anytime, where you get timely and thoughtful responses. Plus, you can schedule weekly videos or phone sessions, all without ever having to sit in an uncomfortable waiting room. BetterHelp is committed to facilitating great therapeutic matches, so they make it easy and free to change counselors if needed. It's more affordable than traditional offline counseling, and financial aid is available. The service is available for clients worldwide. Find the particular expertise you need online. Don't limit yourself to counselors located near you. Everything's convenient, professional, affordable, and you know where to get it, guys. It is BetterHelp.com/PGIR. I'm going to head there right after this episode because I'm still trying to figure out how do you buy your large caps, man? Do we buy them on dips? But we can't even get into swings and day trading.
Yeah. So this is a little different for me because it all kind of manages around taxes. So I obviously run the trading accounts through an LLC. Through that LLC, I pay myself, okay? Because the government makes you take disbursements, and just for the books, it makes more sense for me to pay myself like a regular employee. So when I pay myself, I don't spend like stupid money. Well, a little bit, but what I do is that the money that I have, I bring over to an individual account and I throw it inside a brokerage account. Okay. And so what I do is I identify stocks, large caps, that I think are innovating, that have good balance sheets or good fundamentals, and have a good management team. Because look at Blockbuster. Or even look at Netflix, okay? Blockbuster and Netflix were similar in the sense that they were innovators for their time. Blockbuster, being the rental giant, and Netflix being the mail-in. Now, although different times and one was overlapping the other, the difference is that Blockbuster never innovated. Netflix innovated and they stepped up their game. Okay, so again, I don't want, I'm holding these things for years. So I don't want something that is, going to be a turnkey for a few years. I don't want like a fad. I want something where they're innovating the business. That's why I have like inside my Roth, my average price for Amazon is $9.99. Like literally $999 and like 90 cents or something. And then I also own it inside another account. And even though it's super expensive and like we talked about in the midweek, it would need to double it would almost need to be 8,000 per share for it to double. So I understand that, but I do think the reverse split is coming eventually. But the reason I own so much of it is because they're innovating and they're acquiring other companies. They're moving into, look at what they did with Whole Foods. They're going to try and move into pharmaceuticals. There's so much out there that Amazon's doing on top of the fact that probably, I don't even know, like 80% of the world has an Amazon Prime membership. I probably 80% of the world, something around there. So what do you think? Is that number low?
No, actually this whole time I've been doing the math to find out how much money you would make if you invested $1,000 after Forrest Gump said he made all of his money in Apple stock when the movie came out in 94. And you're looking at a generous return if after Forrest Gump said to invest all of, that's how he got rich was right when the movie came out, you left the movie theater and you bought Apple stock like Forrest Gump, you would be loaded. Sorry.
What would the 1,000 turn into? Do you know yet?
So in 2015, prior to the 4-to-1 split in 2020, it was 93 cents per share. So you multiply that by 4, 9, 18, 27, 36, $3.60 a share. It's now $140, correct? And
there's reverse splits though.
No, if these were all reverse splits, then the 4-to-1 would make it go from 90, because it was 30 cents back then. And I'm looking at other people do the math for 2015. Anyways,
either way, you'd be fucking loaded.
Yeah,
right?
you should have left the movie. I bitch at my mom all the time about that.
And so my point is, but get it to your point is that yes, I do like to wait for dips. I do like to have some cash on the side, but for me, it's more about building bigger positions inside companies that I like. So as far as like scaling into a position, anytime that I get an inflow of money, I'll throw it inside this trading account and I'll scale into a position. I'll just buy like another share or two. So I'm building the position. Although the average doesn't really matter to me, but I also don't want to be opening up a position at all-time highs. I will, if I'm opening up a new position, I will want to wait for some kind of a pullback.
A bad
even if it's
ER. Would a bad ER overreaction be one?
Oh yeah. Because think about this. Okay, we go back to Lots. Now, even though Lots is in the large cap, it's a similar situation to what a lot of companies run into, is that the CEOs and the management overpromise. And when you overpromise and underdeliver, your stock is going to get killed. You'll be down 5-6. We've seen Intel take a 5-6% dump after hours. And 5-6%, in small cap world really isn't a big deal. That can be like $20 billion worth of market cap. Like that's insane. So I don't really worry about the averages unless I'm scaling into a position. Now, as far as the large cap side of things, like I said, I want something with a good balance sheet. Okay, so it needs to be cash heavy. There can't be a chance.
Even if it's one that like everyone knows, like Amazon, Apple, Google, shit like that. Do you think there's ever a point where you're like, oh, this is way too overextended, I should sell? Do you ever take profits on this, or you just hold?
In this account, I'll take profits if it's like something insane. Like I'm talking like if Apple or Amazon ever had like a 15% day, yeah, for sure. But overall, no, I'm just building positions for the future. Like, do I think that Amazon's going to like start beating out Merck and J&J? No, but are they trying to move into the pharmaceuticals? Yes. Do I think that they're going to continue to build out AWS? Yes. They're trying to like take over Thursday. They took over Thursday Night Football. Now I think they're going for Monday night. You know, if they really want to, they can start wedging out people. And why they can do this and move into a bunch of different industries is because they have the cash to do it, which comes back to the balance sheet. So what I'm saying is that it's kind of like a domino effect. Good balance sheet means that you can expand and innovate. Expand and innovate means you can start acquiring companies with new futures and stuff, new technology, new innovation, etc. Then once you get to like crazy levels, now you can start to move into other areas of a similar field, like Apple did. Apple has a GPS now. Who would have thought in the 90s that Apple would be doing GPSs? So, or even like the whole ecosystem that Apple has. So my point is that I'm building a position for the future. Okay. This is way more about quality over quantity. I'm not looking to double or triple, maybe double or triple. I'm looking to outpace the S&P. Yes. But this is for something where like, I want Amazon to have like a $6 trillion market cap by the time I'm ready to retire. And that would make me ecstatic, And so then it's like, I still have cash on the sideline to add on pullbacks, but that's pretty much I'm building for the future.
Okay. Well, moving on to probably something, you won't go as crazy on before we get into swings. So we'll give them a break from that. So we'll start with day trading and then we'll go into swings. So what are some strategies for day trading? Obviously, when you first start trading stocks and you're Googling them, the first thing you find is like the ABCD, strategy for a chart setup. You learn about triple bottoms and the double tops, but what kind of thing are you looking for in, a bull market and a slow market? Like where do these strategies play their best hand?
Yeah. So you're talking about like the day trading strategies?
Yeah.
Okay. So they definitely play the best hand when there's maximized the volume, because volume precedes price action. But I mean, if you don't have if you're a new trader and you don't have that on a sticky note or printed out somewhere, you need to, because that's going to be what takes a parabolic stock nuts. And that's going to be what brings volume to the sympathies, is volume inside that stock to make it go parabolic. So that really, if you're day trading, you could probably do, when you get good, you could probably just have volume up.
With so many gurus and, whenever they tweet or post a message and it gets all this volume, do you think there's such thing as artificial volume, where it may just be quick injection of volume, but it's not exact? Yes, it's real, but unnatural and unsustainable? Or even, you could say the same thing for news. It could just be everyone sees the news, we're going to get in, get out.
Yeah. No, see, I think it's sustainable. The thing that I don't think is sustainable, let me put it this way. I don't think that you can just day trade forever. There's a few reasons that I think that, and honestly, Gary and Tommy might disagree, but this is where I think the evolution of the trader needs to come in, is that obviously you're day trading to build your account, and not to make money, but also to build your account. And so I think that you can day trade for a long time, but if you ever go on a really cold streak, like there's cold streaks and swings, and maybe you lose like 10% of your account if you go on a cold streak. If you're day trading and you have 10 days where you, like, let's just say you had like 50 positions, 50 red positions, day trading, then that mentally wears on you. And it's inevitable that you go on a cold streak. It's inevitable. So I think that one is the mental side of day trading. At least for me, I found that even if it's the same percentage-wise loss on the portfolio, that I do way worse mentally when it's a bunch of losing day trades, like a death by 1,000 cuts kind of thing. And then the second thing is that when you build up your book, obviously you can day trade larger caps, but when you build up your book, you're not going to use. Sometimes you'll just have excess money laying on the side.
But by the same token, your swing could go cold. I get discouraged from swings when I see it red 3-4 days in a row. And I'm like, oh, okay, now I'll buy more. It can't go much lower. And then it keeps going red. You bought the dip, it just keeps on dipping.
Well, see, and this is where I was talking about like the mentality part of it is that with my swings, say I go on a cold streak with the swings, okay? And let's just say I lose 10% of my account because oddly enough, that's usually, I feel like what it is when I go on a cold streak. I can handle losing 10% of my account. Concurrently, if I lose 10% of my account day trading because of a cold streak, but instead of it being 5 positions, it's 40, that screws with my mentality.
Like you lost 40 times instead of just 3.
Yes, exactly. And that screws and even though it's the same nominal amount, it screws with my mentality more. And what used to happen to me, especially when now I'll take a vacation or I'll walk away or I'll size down. But what I used to do was that I would then try and make it back in revenge trade. So it would screw with my mentality and then I would try and go bigger. And then I would lose, try and go bigger. And so what it would do is that it was kind of like the domino effect. And that's what I really liked about swing trading is that because even if I lost 10%, it wouldn't screw with my mentality. So I wouldn't make those let's call them like catastrophic, terrible decisions where you take your account from 10% down to 15%. And now it's like, whoa.
Well, if one of the main things you're basing on the fact that you won't be able to day trade full time is mentality, then I'm going to have to disagree because everyone's got a different mentality. You may just be weak-minded, little man.
Whoa. Dude, I'm built like a bull up here, all right? You can't, dude, nobody lives
Your
rent free up
body's
here.
built like a bull, too.
Dude, nobody lives rent free up in Hugh space. But that's for me, and this is even, we could talk about 2008, okay? 2008, the housing market crash was horrible. But what really set the skids to the market was all the investors selling out their 401ks and selling out everything because they were being emotional humans. And there's nothing wrong with that because we're humans with emotions. But that's what really set 2008.
So this is very Hugh of you to make the whole day trading segment on why you shouldn't day trade.
That's not what I'm saying.
Are you going to tell them how to day trade?
I'm getting there. I'm just saying that I think that there has to be listen, I'm just saying that I think that there has to be an evolution, okay? Because I don't think that, listen, if you can day trade and just day trade for 30 years, hats off to you. I just think that you're an anomaly, personally, okay? Personally. Now, as far as day trading goes, okay.
Shit's changing, old man.
Buy hold. Now, as far as day trading goes, there's 2 strategies that I like. And again, they all center around volume and news. Okay. If you guys have been trading for a little bit, you guys know that sometimes the China education just set off out of nowhere. Yeah.
That means the market sucks.
Yeah. And they just set off out of nowhere. And you have one go
they're the 5? New Oilers.
Oh, and there's no news. Like they're literally just up 600%. Like I'm like, I can't even find volume. It just looks like they open up 600% up. And so I hate those. Now, yes, do they have volume? Yes. And do some people make money on them? Yes. But for me, I need something to hang my hat on. And what that usually is news. So, especially if it's like an underlying news that actually should boost the market cap. So what I mean by that is that if a company has, let's just for sake of argument, let's just say the market cap is 100 million, okay, and they get a $30 million contract for the year, okay, like a one-time $30 million contract. Hypothetically, that means that the market cap should minimum go up 30%. Now, obviously with enough volume and enough people thinking that understanding that 30% adding to the market cap is massive, that's when it can go 50, 60, 100%. But it's something like that, I can look at it and I can justify, me personally, I can justify buying this because they got this massive contract. Something where now, if it was $100 million market cap and they got like a $200,000 contract, that's something that I probably wouldn't buy unless it was like a massive short float and it was more of like a what's the word I'm looking for? Technical analysis kind of thing, kind of play. So I like things with real good news, okay? And it has to be tons of volume. So when I say volume, I mean the relative volume has to be through the roof. So we were trading Clove, and don't quote me exactly, but I think inside the 1 day, 2 weeks ago that Clove went nuts, it had more volume in 1 day than it had previously the entire month prior. Does that sound right?
Yeah. Yeah.
I think that's
what's big, and that's one of the things that kind of hits on my day trading strategy. Is one of my big things that I've really liked whenever sympathies are hitting is the sympathy plays. And Clove, it doesn't just have like Chamath shit and all, and healthcare, whatever. Go straight to SPOCs. So it's like lots can go off, and you have to find the web of sympathy you like, because lots could go off Rocket. Lots could go off other SPACs. And that is my biggest thing is day trading sympathies. You find the runner, you find the lagger. Yeah. If it has options, you buy the option, and you just go for those. I mean, I like to precede the volume. I like to know where the volume's going to be as opposed to following the volume. And that's one of my biggest strategies. And a lot of that is, experience, knowing what runs with what. And screen time.
Yeah, if something's on pace for $500 million of volume, that the sympathy is going to run. And if it's like starting to trend really well, and all the when it dips, those dips are becoming firm and they're starting to really curl up. And the chart, when a chart is starting to look really pretty. Like we talked about earlier, but if you kind of say like, hey, this is my support, and it bounces right there, and then it's like, it create like you just know, you have that feeling, and those are the times where I'll hit that day trade hard. Other than that, you're gonna call me a hater, but other than that, I keep my day trades really small because I don't see the same risk to reward as I do with my swings. But the first strategy is volume. Either on news that is underlying for the underlying equity is good, and I like to play those sympathies. So, for instance, when the meme stocks were running nuts, I think it was BlackBerry got good news, and I figured that if BlackBerry was starting to run again, although it wasn't the main meme stock, it would kind of give a little bit of a boost to all the other ones because they were down a pretty good chunk. So I just bought all the meme stocks, like a few thousand shares of everything. And sure enough, BlackBerry started breaking out, and so did the rest of them go with it. So that's what I enjoy. That's the first strategy because I feel like that one gives me really good risk to reward. Anything to add to that, or you want to move on?
Yeah, I think before we go into swings, is kind of a proper transition for this is another one of my biggest ways, and kind of the way I learned to day trade was, and as I said before we get into swing trading, day trading around a core position of my swing trades. And a lot of doing that, because you're comfortable holding it long term, makes it a little easier on you mentally, because even if it keeps going up, you still have a lot of it. If it keeps going down, you can add more because you're confident on it. And as you day trade something that you're swinging for a 2-month, 3-month span, you learn so much more than just the technicals. You learn the personality of the stock, and learning the personality of the stock is invaluable. There are so many where people would always say, if I was only over 25K, I could day trade this, and I'd buy it at 10 a.m. and I'd sell it at 2 p.m. every day, because that's what it does. But if they had that, it wouldn't exist, and you'd know it's actually 10:30 and 11:30. Then you buy again at noon. That's when it's its lowest. And that's one of the things is screen time and learning the personality. I think is one of the biggest things for day trading around a core position. And then also using those breakouts. I've never been a breakout trader, but for those people that are willing to slap the wall or see that resistance broke, my main thing is I just like to be in before the chart gets to the point where it's, to a point where it's breaking out more because, you see those, hey, it's about to break VO up again. It's already up 33%. I don't feel comfortable doing that, but the more technical traders can absolutely do that. And that's one of the more impressive things. I do want to learn more, how to trade that.
It's funny that you mentioned trading around the core because I actually got asked on Tuesday night. I got asked if I make money every week, and that's a tough question as a swing trader because it's like yeah, like on paper yes, or on paper no, but it's not realized. But trading around the core, I didn't used to do this at all, but trading around the core helps to lock in some of that profit so that I can pay myself so that even if I'm not selling a majority of my positions for a month, let's just call it that I don't sell anything in July. If I trade around the core a little bit on those massive days where the market's just up and everything's doing well, let's just say it's up 7% and I cut, even 10% of my position, that pays for rent, that pays for, all the bills and a little bit of fun money. And so that's the way that I kind of look at it is that I can pay myself and all I do is pay myself with the profits. I'm not taking out of my account. I'm saying, okay, I made X amount of money on this trade from this, and so I'll take that out of the account. And then on a dip, I'll buy back so that I'm just replacing those shares and recycling. So then when it goes back up to that area, it's like nothing even happened. And obviously sometimes it doesn't come back down to that area. It doesn't come back down to that area or something. But when it does, a stock always dips. Always. So when it dips, I'll just scale it back into that position, average up a little bit. When I see that confirmation, like we talked about earlier with the large caps, when it comes down, back testing that support and confirmation of the curl, that's when I'll scale back into it. And even if I'm averaging up, that's okay. That's okay because I lock some profit. So if an RS or a massive offering came out, I at least lock some profit.
All right, now we can move to your bread and butter, the swings. Adding them, doing the DD, how you want to do it, and kick us off. There you go.
Yeah.
Heat up a pizza.
So the first thing that we have to talk about with the swings is it always has to check all the boxes. And what I mean by that is that when I say all the boxes, I mean that I create a 10-step matrix and I needed to check at least 6 or 7 of these boxes for me to even be interested. And what I mean by that is that I used to notice that I would get really emotional about a company, and I would believe everything that the CEO said, and I would expect massive press releases, and I had unreal expectations, and that was just my own bias. That was just my own bias getting inside the way. And so I created this matrix when I started to realize that I was getting too emotional about these stocks, and I was marrying stocks. Like I really was marrying stocks. I said that, like this thing's going to $1,000 a share, it'd be like 60 cents. Terrible balance sheet. And I would say, oh, like they'll figure out the money, as long as the underlying product is good, it's fine. And that's not true. So I created a matrix, and a lot of people ask me for it. It is proprietary, so I don't give it out openly. But for the podcast, there are a few things. Like for instance, it takes the emotion out of it. So one of the things that this checklist covers is that it covers it covers things that you can quantify, like for instance, how much cash they have. So everything is based on a rating out of 10. So it does give, okay, hey, they have cash for the next 3 years. Great. That's a 10 out of 10, or hey, they have cash for the next year, but it'll be tight. That might be like a 5 or something, or a 6. And so that's something that you can quantify and take the emotions out of it. That being said, on the checklist, though, there are things that you can't quantify, like, for instance, the management. We talked about in large caps that I invest in management teams. I am investing in the products, but I'd much rather invest inside a great management team. So, although you can't sit there and quantify management teams, I can get a pretty good idea or a pretty good gut check and go off of that. So then once I score these 10 different scores, if I wanted to go, let's call it like all in on a stock, but then I go through these metrics and I realize, okay, hey, this only has like a 6 or a 7 rating. Their cash is a little low. Management seems like they're a little pumpy. That's not great. Or we could throw something in like, hey, seasonality for the fall is not great. It's usually their worst quarter. Something along those lines. Then I can say, okay, let's see, it kind of puts my ego in check and my emotions in check. And I say, okay, this isn't the stock that I want to, I'll take a scrap because I still like the catalyst or I still like the thesis, but this isn't one where, I'm going to hold down and I'm going to add all dips and everything like that. So that's what I would say is that I would go, if you want to be a swing trader, you have to understand what strategies work best for you. And so what I mean by that is like, are you more of like a bio person? Are you more of a hold the entire, if you think weed's going to run this summer, are you someone that's just going to go all in on the weeds and wait for them to run? Are you going to be like a theme trader?
Are you a holder and sell in a year? Or are you a scale out? I mean, you do 10% every 10%. Do you do?
And there's so many.
I think that's one of the biggest things. Like you as a swing trader need to talk about, because me as a swing trader, man, I was out of FUBO at 40%. I was, Zach called it at like 10. or 9. I was in at 10. I was all the way out at 14 or 15. By the time it hit 60, I was just crying every day. So I mean, like, what is your scale out method? Do you wait for news and sell it all?
Well, so it's based on like a system. It's not a systematic approach. And what I mean by that is if it's news that isn't the news that I'm waiting for. So let's say that I'm waiting for a product let's just say that I'm waiting for a product.
And they have a good ER.
And they have a good earnings. Yeah, exactly. Then, and the stock goes up, let's just call it like 30%. I'll cut half my position because that's
it's going to come down.
It's going to come down, especially if the earnings report shouldn't reflect that. So again, we talked about earlier about day trading the news. Same thing with the swings. If the earnings report is like a 10% increase in revenue, or let's even call it like a 20% increase in revenue, that's not really that for like a $1 billion company. That shouldn't be that impressive. If it brings the revenue up from 50 million to 55 million or 60 million, that's really not that impressive, and the stock shouldn't be up that much from a fundamental standpoint. So I'll cut half the position. And if it squeezes, it sucks, but I'm still happy because I still have a pretty big position in there. So if there's news that I wasn't expecting, or it's not the news I'm looking for, then on resistance points, I'll cut a little bit. And then if it starts, then I'll have like a trailing stop loss so that it takes my emotions out of it. And that's the biggest thing is that, so for instance, if the stock's at $1 a share and it flies up to $1.40 per share, and on resistance, I'll cut some, and let's just say the resistance point's 150. I'll cut some, right after the resistance point, and then I'll just play the price action from there. So if it starts to break down, then I'll start to cut it. If it starts to firm up, maybe I'll even add some to the position. But for a day trade, I'm not swinging that. Okay, because the underlying goal and the overall goal is to then buy those shares back at a lower price. So I will buy it inside the day trading account, and I will even inside the swing account, I'll day trade it. But if the underlying equity shouldn't reflect that kind of price action, then I have no problem cutting half of my position. So that's the one way to scale out. The other way is that if it gets really overextended, so let's just say during the day, the stock's up like 15% simply because the rest of the themes are going. I have no problem cutting some. I'll cut a third of my position or half of it. If it really starts to squeeze hard, I'll do whatever, I'll cut some, I'll lock some profit. And that minimizes my risk because eventually the more profit that you take and the more that you recycle shares, that becomes a free position. So I have no issue cutting. If it's up 15-20%, I have no problem cutting, especially if it has no news or anything. So that's the other way. And then if we're talking about purely like a slow grinder, so I am a catalyst trader for the most part. So I'm not like the Warren Buffett buy, hold, wait for good earnings reports, wait for updates on the business. That's not really my thing. Like that, like he likes like the slow movement. I do like to add dips, and then when news comes, a massive pop. That's like my thing. But if it is a slow grinder, then when it gets closer to overall big resistance points, I'll start to cut some. And it's just, again, the same thing. It's that I'm playing the price action, but I also want to lock some profit. And so I think it's really important that if you have a newer account, that you have to understand that, you can't take the risk of seeing if it's going to break resistance. Okay, sure, you can hold some shares, but like for the guys that were holding, what was it that went? Like, let's just say that you start accumulating China education plays because you just know that one day you'll wake up 600%. If you do wake up and it's up, let's call it 200%, but you were hoping for 500%, you can't risk.
Yeah, price targets, you got to throw them out the window.
You got to throw them out the window.
Yeah, I mean, you see someone take price target, but it's, it may be a target, but you got to be happy with, sometimes just anywhere near it. Green is green, man. Green is green.
No, exactly.
For someone, they're working and they just see, people's tweets.
Oh, I remember that. Yeah.
So I think, one thing is to give some advice to them. Mine obviously would be to find the one you trust, find the one whose plays have worked out for you. You're a grown ass man playing the stock market. You're a grown ass man or woman playing the stock market. You've got to be responsible. You need to know, like, why am I adding this? Am I just adding this because this person said so? If they have a 90% track record with you, then sure, hell yeah, go for it if that's what you're comfortable with. However, you also still may want to look into the company. You should always look into the company if you're going to swing something for a long period of time, especially if someone on the internet's just telling you to. But what kind of advice would you give that person that doesn't exactly have all the time in the world and they're just trying to swing, get out of there like 9 to 5?
Yeah. I'm going to try and do this without overheating and getting myself all worked up. But everybody wants to make the quick buck. And that's not how this game works. Okay. If you don't have the time, throw it in a mutual fund. Because if you don't have, this game is not wake up. Like I know all those YouTube ads that show like I trade for an hour a day, make $10,000 and then go on my private jet to the beach. That's not what this is. I can show you that I get between 3 to 4 hours of sleep.
Those people aren't listening to the pennies going in raw.
No, they're not. And that's you know what I mean? And I think that's so stupid. Like, look, like literally last night, random night, 4 hours, 12 minutes worth of sleep. That's it. And it's not only because I'm sitting there doing DD and stuff, but I'm just excited about work and I'm excited about to get to the desk. Okay. I think it's such bullshit when it's like, I come to the market, I make 10 grand, I go on my day. Yeah, sure you do. But that's not real. So if you don't have the time, you shouldn't be inside this game. Throw it inside a target fund, throw it inside a mutual fund, and let Vanguard do the work for you. That being said, if you're trying to make this work, then you need to work your butt off. And so I kind of like the way that I did it was 3 different stages. So I didn't rely on any income from trading. Then I started to scale back the job that worked during the day so I could be at the desk. So I moved more to nighttime jobs, weekend jobs, so I could focus on trading because I was starting to really get the hang of it. And then that's when I decided I was going to go full time so I could completely focus on trading after school. And so again, I was lucky enough that I lived with my parents during the summer, that by the time that college rolled around, I had real expenses, that I was profitable, and I had saved up money from working jobs. But if you want to make this work, you got to put in the time and the effort. An hour before, wake up an hour early. Once you put the kids down at 8, 9 p.m., instead of having that glass of wine, sit down at the computer. Okay, it sucks. It sucks in the beginning, but the learning curve is literally so steep. It's like the steepest roller coaster in the world. But once you're up there and once you have those things, it's like riding a bike. You never really forget, like what a 10K is. Like it sounds so simple now, like we chuckle at it. But when you're first sitting there and you're looking at different filings, I mean, my head was going nuts. I like 10K. What is the fucking point of it? Like, just call it the report, just call it what it is. But once you learn those things, it's muscle memory. So make it work by fitting it inside your schedule. Go to the bathroom. Now, if you are playing people on Twitter's alerts, okay, you have to understand that the Twitter is like an inside look and a journal into what these traders are thinking. Okay, none of these guys have their Series 7. None of them want their Series 7. None of them want outside capital. Okay. And so if you are playing their positions, especially if you're playing swings, there is no reason to just sit there and market buy. Okay. You need to go through, understand the DD behind it, and see if that's if you agree with it. Like, just because the DD is out there doesn't mean that it's always right. It also doesn't mean that that's how it's going to play out. The company could throw, let's take AHT. The company could throw out a reverse split, or, the company could throw out a reverse split. The company could throw out a massive dilution, anything, or let's take MDLY today. They halted and they're going bankrupt. They're just going to close the doors. A public company, MDLY.
So it's funny you mentioned that, because I was going to mention this later, but it fits in right now. Jim Cramer tweeted about an hour and a half, 2 hours ago, Newegg, $2 million in sales, $25 billion in market cap. That's the definition of ridiculous. And while I agree, and some people are saying, we're investing in, what's to come. We think there's a lot to come. Do you know what Newegg is?
I saw the stock. I really didn't.
Newegg is a website where they sell computer parts, and it's been around for a long time. Like, even back when I was playing World of Warcraft a long time ago, like semi-professionally, not to brag. That's where like the really good gamers bought all their stuff. If you wanted computer parts, you went to Newegg to get it.
Oh.
My thought is kind of, you think of gamers, you think of people that are big PC guys, you think of Reddit. You think of Wall Street, Reddit. You think of Reddit, you think of Wall Street bets. Do you think this is kind of a similar thing to, all the meme stocks that ran? Most of them were nostalgia stocks that were shorted as basically the hedge fund saying, this is going to die. Well, us 90s babies don't want GameStop to die. We don't want AMC to die. We certainly don't want Newegg to die. And I don't know the short report on Newegg by any means. But do you think that kind of has anything to do with it, with the demographic of people that use Newegg?
Well, see, here's what I struggle with is that, do I think like 50,000 people throwing $5,000 at this thing is making this thing 8x inside the past 20 days? But this comes back to, and again, disclaimer, I know I sound nuts. Like I get like a few DMs like, dude, you sound like a crazy person every time that we talk about this. But it's the same thing like how market makers use the S&P or use headlines inside the market to control the market. So for instance, or sometimes a report will come out or breaking news will come out that let's even say something stupid like for instance like July 4th that the average American picnic was down like 16 cents, like the cost to have a picnic. Okay. Market makers will use headlines like that to move the market, because you can't just move the market 2-3% for the fuck of it. I mean, I guess you could, but it sounds a lot better when it's on the news, like, oh, the market was down 2% today after a report that, they're not saying that that's why the market's down, but they're saying that coincidentally, when this headline came out, the market did this. Okay. And so if you look back at time and you do like a seasonality for it, it doesn't always like every time that we have negotiations for OPEC or something, the market doesn't do the same thing. And that's because market makers control the market and not hide, that's not the right word, but use headlines to justify the move inside the market. And that's the same thing, I think, with neg and these other massive squeezes, like 800% to the upside, is that there is somebody bigger behind this. There is somebody bigger behind this. I truthfully do not think that 50,000 people throwing $5,000 at this thing would do this or could do this. I mean, the math just doesn't add up based on like the volume. But I do think that, again, that yes, market makers use that sentiment and use that to their advantage. So to answer your question, yes, I do think that plays a part in it. But do I think that it's, bunch of Robin Hood teenagers throwing $200, $5,000, $200, $400, $5,000 at it? No.
All right. Well, we have been at it for damn near an hour, a little bit longer. I just was going to say damn near an hour because usually we edit out about, 4 minutes or 5 minutes. So have you gotten your swings out, or are you good? This is an episode now. This is a lengthy one. We haven't done an hour episode in a while.
I feel like we haven't done like a good like learning one, or like I haven't really gotten to.
Yeah, we got to get some facts. Well, no, yeah, you definitely got your ranting out this episode. So
I'm sweating over here.
Yeah, you are. All right, boys. Well, we really appreciate you guys to the 7 people that are still listening. After all of that, we really appreciate you guys sticking around. I hope you guys have had a great weekend. Make sure to leave us 5 stars, subscribe, be nice to us on Twitter, and we will see you guys on Wednesday. Thank you guys so much. See you then. This episode is brought to you by Benzinga. Benzinga is our absolute favorite resource to use when we trade. We use it for news scanners. We use it for float checkers. We use it for screening. We use it for just about everything, including chat rooms and much, much more. But that's not all they have. They have YouTube as well. Hot Stocks Luke every single day has great guests on, ranging from Ripster to Mia Khalifa to Gary to all the best guests you need to hear from every single day, all day long. So make sure to go check that out. That's youtube.com/Benzinga. And if you look in the replies to this tweet, you will see how to get a discount code for Benzinga Pro. Make sure to go sign up for Benzinga Pro right now.